I want to go out right now to Cincinnati in the great state of Ohio and talk with Matt McCormick. He is Vice President, Portfolio Manager at Bahl Gaynor. And Matt, thanks for joining us. Hopefully you can shed some light on what's going on in this market. We didn't get what a lot of people said would have been nice for the markets from Ben Bernanke, and that is talk of QE3. We've got a hurricane coming as well. We got bad GDP data, so the economy's not looking great. Why do stocks gain after that?
I think when you look at what many people were expecting today, and that was the case that there would not be a QE3, you saw the market sell off yesterday, Matt. I think what a lot of people tended to focus on was Mr. Bernanke's comments about, he was a little bit more optimistic about not being in a recession, how he is optimistic about stronger GDP growth, and he talked about how he'll address the QE3 issue in September with a 2-day meeting instead of one. So that implies the door is still open where they could get some stimulation from the Fed, but I think a lot of people are focusing on his more optimistic comments, and I think really the idea about QE3 was addressed in yesterday's sell-off. So I think people are being a little bit more optimistic. They're focusing on the future. However, I think people need to be a little bit realistic in this economy that is still, when you look at GDP growth, annualizing at 1%, there are challenges, there are questions, and I think people need to focus on more needs versus wants, and that's why we recommend high-quality companies with dividends. We think that's the way to play not only this environment, but particularly for the next 10 years, Matt.
Are you concerned, though, that Ben Bernanke does go in later and execute some of the measures we've been hearing about, for example, going out and buying in on the longer end of the curve or lowering the amount of interest that they pay banks for excess reserves? I mean, is it concern to you that they do something in the future to signify that they really do feel this economy is in serious trouble?
I absolutely do. I think his efforts, if he does initiate QE3, Matt, will ultimately fail, as I would argue QE2 has failed. When you look at QE1, you roughly had a 75.1% return in the S&P 500. QE2 was a 26.2% return. If he did QE3 by the law of diminishing returns, you're probably getting an 8 to 9% clip. Not bad environment where the market's essentially flat, but ultimately all it does is stimulate the economy with a false hope. And we've seen what happens every time QE1 or QE2 ends, the market sells off, and the market has to stand on its own 2 feet. And that's why we're seeing the volatility. We prefer to invest in companies that can grow their earnings and their dividends without the government's help. These are products that people need and use on an everyday basis. I don't want to buy stocks on the hope that Ben Bernanke will make me money. I don't like it at all. I'd rather have something that can earn money on their own. And I think ultimately Ben Bernanke wants to find a way to have his cake and eat it too. And what he's essentially done is, in my mind, pulled something out of the ECP playbook and say, hey, just wait a little bit more. We're going to have a great plan, and punt down the road. And I think the market's focusing on some of his kind words as opposed to economic reality, where we see in some of the reports that came out today, Matt.
Matt McCormick, not Matt Miller. This is Margaret, Brennan. What would actually make money without some form of stimulus help, maybe fiscally there? Because you're still talking about a consumer that's waiting for President Obama to give us a jobs address on September the 5th. You're waiting for Bernanke to perhaps pick up the punt that he kicked today in terms of that FOMC meeting. I mean, do you truly believe that stimulus is done for the foreseeable future?
Margaret, when I look at what has happened with the stimulus, where essentially we have tried everything but throw the kitchen sink out of it, ultimately you look at what do we have, and I think their efforts are a failure. When you look at what is happening here in terms of the government plans and their Keynesian economics, which I don't agree with, you're looking at companies that have basically seen the returns evaporate since QE2 was initiated. We like companies like Procter & Gamble, which are the quintessential staple stock, where people need, you hope, they need to brush their teeth and use shampoo on a daily basis. We like companies like Intel, which continue to use the backbone of the economy. One name we really like is Digital Realty Trust, which is a REIT, which is involved with disaster recovery. It has a 4.7 yield. And if you look what's happening with Irene, every single chief information officer is reviewing their disaster recovery plan right now, and DLR has 96 sites worldwide. It's the actual space for housing all of their the servers. So we think people are focusing on needs, not wants. Their earnings growth may not be gargantuan, but they can grow their earnings and their dividends through difficult market times. We think investors are going to focus on these issues. Another name we like is McDonald's. which right now has nearly a 2.8 yield. You look at the 10-year Treasury yielding 2.2. Over the next 10 years, I have to believe McDonald's is going to outperform the 10-year Treasury. And I think investors are focusing on blue chip companies with strong balance sheets without the government support. If you look at what the government has done so far, and you look at where we are with unemployment, volatile equity returns, my God, why would anybody want any more government help? It's not doing it, Margaret.
Hey, Matt, let me go ahead and take it here, and thank you for joining us. Matt McCormick there from Bahl Gaynor, joining us from Cincinnati.